Hello and welcome back, everybody. Man, I've had a seriously busy last couple of weekends, but I'm happy to finally get a chance to sit here and drink beer and talk about my favorite subject, which is stocks and the stock market, which is a subject that none of my friends like to talk about. So I'm happy that you all tune in so I get a chance to talk to you guys about this. And this channel itself may never monetize, and I'll never make any serious money out of this thing. But I'll tell you, researching the topic of stocks and actually researching stuff for these videos helps keep me on top of the stock market. So in that way, I'm making plenty of money from this channel. So I thank you guys for checking this out. Hopefully you all are making lots of money too, not doing what I do, hopefully, but just in your own way in the stock market, making some cash. All right. So this past week we had a real roller coaster week, and that was because on Tuesday we had a far hotter than expected CPI report, and that would be your inflation report. And then after that we had an unexpectedly weak retail sales report, which brought interest rates down and the stock market went back up again. But then after that, we had a hotter than expected PPI report, and that came out on Friday, which sent interest rates back up and the stock market back down again. And so what we're going to do is we're going to have a look at the quick relationship between interest rates and the stock market. Interest rates would be like the dog, and the stock market is like the tail. So it's a good indicator of what direction the market is going to go in. But not all sectors are affected by these interest rates the same. Some are affected a little bit more than others. We'll go into a couple of the sectors that are affected a little bit more, as well as a stock in my portfolio that's affected like not at all by interest rates. So it might be worth something looking into for you guys. We'll also look into the next inflation print, which way I believe. I'm going to break out the math and the calculator, and we'll figure out where inflation is headed with the next print that comes out on March 12th. We'll talk about what I'm going to be doing with this NVIDIA earnings. And then lastly, we'll look at my options portfolio, and you can just see what kind of options I have open and where I think the market is headed in the near future. All right, so there's a lot to unpack, so let's go ahead and get into this. So the U.S. 10-year Treasury is sitting at 4.281% this week. Let's just kind of talk about what this means. So the federal funds rate right now is 5.3%. Now let's say that this is 4.3%, just for easy math. Every rate cut is 0.25%, or what they would call 25 basis points on your investing channels on CNBC. So we can see that the difference between 5.3 and 4.3 is 100, meaning that the market is currently pricing in 4 rate cuts over the next year. Now you can see that before the CPI print way down here, we were pricing in 5 rate cuts. But what happened was the CPI print came in really hot, and then the interest rate, the 10-year Treasury went straight up saying, hey, we don't think the Fed is going to make as many cuts as we did, say, a few hours ago. But then the retail sales report came out really weak, and it started saying, well, maybe the Fed is going to cut. And that's what brought interest rates down. Bringing the interest rates down also sends the stock market up. However, then the PPI came out, and it basically just sent us back up to where we were after the CPI came out. And the PPI said that our inflation rate is going to be really high with the next print in March. But what did this do to certain stocks, and how does certain stocks react to this? So one of the ones I like to look at here, there's two. One is the ITB. The ITB is the exchange traded fund, or the ETF for the housing stocks. And we can see that the constituents of this ITB ETF, they include stocks like Lennar, they include DR Horton, NVR, whatever that is, Pulte, Home Depot, Lowe's, and the like. And so what is happening is that prior to interest rates what we believe interest rates are going down, that greatly affects these housing stocks. So lower interest rates are really good for these stocks, but they don't wait until after the inflation has come down. What happens is that this was on Monday before. This was in preparation for a really nice and gentle CPI report. We can see that the ITB went up to $105 a share. And then as soon as the inflation report came out, it plunged right here from 105 all the way down to 100. So we can see that this came down about 4.4%. And then it kind of stabilized and it kind of went its own way. But we can see that it went up before the inflation print and down immediately afterwards. So if you really want to be kind of cheeky, this might be a fun one to get into a few days before that next inflation print, depending on where you think that this thing is going to go. Now, another sector that seems to be really affected by these interest rates is the financial sector or the banking sector. And I happen to own Goldman Sachs, so I watch this happen out in real time. And the same thing happened, okay? So they were expecting a cooler than expected inflation print. And look at that, this thing just ran up. And I'm sitting there going, what in the world's going on? But all it was doing on Monday was kind of preparing for a really good inflation print on Tuesday. And so they didn't get it, and wham, it got smoked, and it was down to 4.25%. Now you might say, well, the whole market came down on that day. That is correct. However, the S&P didn't come down as much as these two stocks. So these, well, the ETF and Goldman Sachs. And we could see that on that day, the broader S&P came down 1.91%, whereas those stocks were down 4.2 and 4.4%. So they come down about over twice as hard as the broader S&P, but they also go up over twice as hard when they were expecting good data. So these are fun ones to be in when we're expecting interest rate cuts. So those are ways to grab up some quick cash if you think that interest rates are going to be coming down because we're going to be getting cooler than expected inflation. Now, what you might expect is that this volatility in the interest rates, if we think that the interest rates are going to stay high, it would have a really negative effect on our small cap stocks. We would expect that the Russell 2000 would far underperform, say, the S&P 500. But we could see that over the last 5 days, that wasn't the case at all. Actually, the S&P was down 0.24% last week. The Russell was up 0.91%. If we look over, like, say, the past month, again, the Russell has, it's come on way, pretty much in line, but it's slightly outperformed the S&P 500. This isn't what I would expect if I'm expecting, higher interest rates. Let's go ahead and see how the equal weight S&P compares to, say, the market weight S&P. And we could see that of these here over the past month, the Russell has outperformed both of them. Over the last 5 days, we can see that the equal weight and the Russell both outperformed the S&P just slightly. And so this has something to do right here. I believe this has to do with valuations of the sectors. The Mag 7 gets a lot of publicity for being so overvalued, if you will, but really it's much more broad than that. Let's go ahead and look at all the PEs of the Dow 30 stocks. So here's a quick snapshot of the Dow 30 component. So this is the 30 stocks that make up the Dow Jones Industrial Average. On here, you can see this is the price to earnings ratio of all of these stocks. The market's currently trading at 20 times, which is considered a little bit rich. Normally it likes to trade at about 19 times. So anything greater than 20 on this list is going to be considered richer than the S&P 500. Anything under 20 would be trading at a discount to the S&P 500. Now we can see that most of these stocks here are trading above the 20 S&P 500 benchmark. You can see United Health is sitting here at 21. Now Microsoft, basically the Mag 7 in general catch a lot of grief for trading really rich relative to the S&P. We can see that that is the case. They are rich compared to the 20 S&P. It's trading at 36 times. However, that's not accounting for, say, the net margins that these stocks have. A lot of these, 10% is considered a great net margin. These things have margins of like 30 and 40%. They also account for about 98% of all of the earnings growth in the entire S&P 500. And that would be a reason why that it's trading at 36 times. Plus, if you're going to have interest rates that are really volatile, these companies here, they don't need to borrow money. I mean, they're essentially cash flow machines. They have bulletproof balance sheets. This is kind of your safety trade if interest rates are going to remain high. And that would be the reason why these price to earnings ratio are a bit elevated. Now we can see Goldman Sachs is trading at 16 times, Home Depot 22, Caterpillar 16. So your industrials, your financials, your energy stocks are always going to trade to a discount to the S&P 500, so that's not surprising. You can see Salesforce is trading at 108 times, so it's ridiculously expensive. Visa always trades over 30 times. Not sure why, it's just something it always does. So don't be scared off by this large price to earnings ratio, but it does always trade incredibly rich, though nobody's allowed to talk about it. We don't talk about that on CNBC, but yeah, it always trades really rich. The only ones that trade rich are Apple and Microsoft. That's it. Apple does trade rich. IBM's trading rich. Walmart, Procter and Gamble and Johnson & Johnson are all trading really rich, which is not surprising because we have Japan going into a recession this past week. We got Germany declared a recession this past week, and in the United States, for its part, certainly been going through, say, like a rolling recession. Through different sectors are having recessions at different times, and so a lot of these like recession plays, like Walmart, Procter and Gamble, and Johnson & Johnson are going to trade at a very high price to earnings ratio, though they never going to talk about that being high. I mean, I don't believe I've never turned on CNBC and heard about how rich Johnson & Johnson and Procter & Gamble are trading. It just isn't something they talk about. Of course, your energy sector stocks like Chevron are going to be trading below the sector average. Nike is incredibly rich. Walt Disney is trading at 77 times. 3M doesn't have a price to earnings ratio, indicating that it's losing money. And by the way, same goes for Boeing. It's not making any money. It's having, the little door plug shoot off the side of their airplanes in mid-flight. When that happens, this stock only goes down about 8 or 9%, whereas like Expedia or PayPal can blow away their earnings and their revenue and everything like that, and their stock will plunge like 25%. This one will go down about 8% on news of their aircrafts being blown apart in midair. But I digress. It's the way that the market works. The bigger ones are, I guess, harder to squash than some of those little ones. So be careful if you get the little stocks. Okay, so Coca-Cola again is trading rich. Dow here, Dow Chemical, which you never hear about the price to earnings ratio of this thing, is trading at 66 times. Let us hear. Intel is trading at 130 times, and Walgreens is trading at 34 times. So the point of this little exercise is just to show you that a lot of these bigger market cap weighted stocks are trading very rich relative to the S&P 500. So that would be a reason why, even though interest rates stay elevated, that we might see that the Russell 2000 or that the equal weight S&P might actually trade favorably to the S&P 500. All right, so now that we've talked about that, let's go ahead and look forward to what we expect of the next inflation print that's going to come out here on March 12th. So March 12th is the date this is supposed to come out. If we look and see what actually went into, or what were the drivers of this hotter than expected inflation print that we just had, we can see that it was going to be food, energy came down, new vehicles and used cars and trucks, that went from 0.2 to 0, so that came down. Used cars came down, apparel came down. Really, the driver of this entire thing was this. It was the shelter. The shelter price unexpectedly went up, and the shelter is about 42% of this entire index. So if the rents do come down, as like Redfin and other real estate firms and seem to be indicating that rents are coming down, we would expect the shelter price to go down. Now, I don't know if this accounts for the price of selling homes, but in any case, these large real estate companies do seem to indicate that the shelter costs are coming down. So this was an unexpected rise. So it wouldn't be out of line to expect that this number from 0.3 might be down next month, say to more closer to this 0.2. And we'll use 0.2 as our gauge that we're going to do for the next CPI print that comes out on March 12th. And then from that, we can guess which way interest rates are going. And then from that, we can guess whether or not we get into home stocks or maybe financials and have a little bit of fun around that inflation print. Now, before we do that, let's go ahead and look at this last inflation print, and we can and just kind of analyze it, just kind of see how it is we get this number. And then for those of you that have watched this channel a lot, we know how we do this. So all we have to do is take this number here, which is 309.685, and divide that number by this number here, which is 300.356. And that gets you to the 3.1% that it said that we were at year over year, 3.1%. Now we're predicting that it's going to go up, say, 0.2% next month. And so we would take this number 309.685 and multiply that by 1.002, and that would get us our new number that we would expect at the end of next month, which would be 310.304. And you divide that by this steep line on this side, which is 301.509, divided by 301.509. And so we would expect that our inflation print for next month is going to be 2.9% year over year. Now this 2 in front of it might get somebody real excited. It might not, but a lot of that's going to depend upon our expectation of what we expect the next inflation print to be. So, and that would come from the consensus. That doesn't come from the forecast. Like, you know that this past week we had a really negative reaction to the inflation print, and that's because it came out at 3.1%, which is what was forecast. However, the consensus wanted much lower at 2.9%, and because it didn't hit consensus, the market, dove straight down. Now, if next month I'm saying 2.9%, if the consensus is also 2.9%, it's going to be a pretty, flat sort of, I predict anyway, a pretty flat reaction to the stock market. Now, just having the 2 in front might actually just send it up regardless of what the expectation is or whatever the consensus is. But generally speaking, if you come in below consensus, that's good. If you come in at consensus, that's all right. And if you come in above consensus like this, it tends to send the market in a direction that we as investors don't like it going in. So that's what I'm expecting. I'm expecting 2.9%. I'm expecting that the 2 in front is actually going to be very positive, like psychologically, like we're breaking below that 3. I think it's going to, having that 2 in front is going to be psychological. So even if it comes in at a consensus, I would expect that the market's going to go up and interest rates are going to come down in anticipation of Fed rate cuts. Now, I'm also expecting a bit of a tailwind from next week's NVIDIA earnings. I think that they're going to over-deliver. I think that they're going to beat on their revenue and earnings, and they're going to raise their outlook. So they're going to beat and raise this Wednesday. So that's going to send the market up. So we have one catalyst next week, and then we have another catalyst in a couple more weeks. So I'm not quite ready to exit this market and go into like get really defensive yet. I still think we have a couple more weeks of good stuff before I go into my little cocoon of maybe just U.S. Treasury or something for a little bit, while I wait for this thing to bounce back. Or if I think that something is going to stay pretty high, just buy it and then kind of sell calls against it, make a little bit of money in the meantime. So at the beginning of this video, I said I would show you one stock that I own that's not affected by interest rates at all. At least it doesn't seem to be. And that stock is Novo Nordisk. Novo Nordisk is the makers of Ozempic, and they also make Wegovy. And you can see that this past week we've had like a roller coaster session right here. We got the S&P that's down about 0.24% over the week, but Novo Nordisk was up 3.37%. And these weight loss drugs seem to be kind of like healthcare's answer to AI. And now Novo Nordisk is the maker of Ozempic, and they also make Wegovy. And there's a slight difference between the two. Ozempic is used to treat type 2 diabetes, whereas Wegovy is just strictly for weight loss and long-term weight management. Now, Eli Lilly has their answer to Ozempic and to Wegovy. They use Zepbound and Mounjaro. And the difference between these two that Eli Lilly make are negligible according to this article. But Mounjaro was used to treat obesity, also type 2 diabetes, versus Zepbound, which was just here recently approved by FDA, is now also like a weight loss drug. So this would be kind of like Eli Lilly's answer to Novo Nordisk, Ozempic and Wegovy. And is it going to step on their market share? I mean, sure. I mean, it could, but again, my belief is there's enough fat people to go around that if Merck wants to come out with these and Pfizer and everybody else, there's still going to be plenty of market share for all of these. But I do believe that Ozempic and Wegovy kind of get like that first mover type of advantage when it comes to these sorts of things, but maybe not. I mean, I'm not an expert on this sort of thing. All I know is this stock seems to be unaffected by interest rates and does just seem to go up. And so it's a fun one to hold. Like, it's fun when the market's having a bad day and you've got Novo Nordisk and it's still going up. That's a fun day. So let's have a look at my options portfolio. So when we look at my options here, you can see that I've got several positions open. I have, I recently bought 4 puts on DWAC. So what this says is if DWAC is below $17.50 a share by the 21st of June, I stand to make a lot more money than the $698 it take to buy all of these puts. This was a pretty cheap put for me to buy. We'll see how this goes out, how this goes down as time goes on. We'll see. Amazon, I've sold 2 calls on that. I'm currently up on those, so indicating that Amazon has been coming down. These 2 calls expire on the 23rd, which is this Friday. If Amazon is below 177.50, I get to keep all of my Amazon and I get to keep their $220. Again, like I said, I'm having fun with Novo Nordisk. These ones I'm underwater on these 2 covered calls because no matter what the market does, this one goes up. These expire on the 1st of March. I'll let them go, and then I'll sell puts and get them back. But I really like this one. I don't see myself exiting this Novo Nordisk position anytime soon. I mean, because it hasn't bitten me yet. And so I tend to just stay with things that seem to run. And this seems to be one that's running. My Goldman position's always really nice and steady. But the fun one here is actually my NVIDIA position. So I sold a put after earnings here. This one expires on the 23rd of February. NVIDIA announces their earnings, I believe, on the 22nd of February. And so what it says is if it's below $690 on the 23rd of February, I'm agreeing to buy NVIDIA for $690 a share. If it stays above $690, that means that I get to keep your $2,100 and I don't buy any NVIDIA. Now, they paid me $2,100 for this contract, which means that my break even on this contract is $669. So if this thing should not fall below $669, I tend to be in the green on this trade and I get to make the decision whether I want to buy 100 shares of NVIDIA at that price or whether I just want to cash out on this option. So that's how I'm playing the NVIDIA earnings this week. And now just for fun, and I wasn't going to go into this, why am I buying this put on DWAC? And what is DWAC? So let's go ahead and go into this because this is actually kind of fun to talk about. So DWAC stands for Digital World Acquisition Corp. And we can see that this is a blank check company that is trading for about $50 a share. Now, it's trading so expensive because it's going to be bringing public this social media platform called Truth Social, and they recently just agreed to merge with this social media company. Now, one of the problems that this social media company has is that it has a market cap of $1.8 billion. And when you look at the financials, it tends to lose astronomical amounts of money quarter after quarter. And it's not getting better, it's getting worse. And I would venture a guess that this little blip to the upside, probably a typo. So it went from losing 3.8 to 5.5 to 9.0 to $12.1 million quarter over quarter. This thing is dying is what it's doing. Nevertheless, this blank check company that's going to bring it public is trading for $48.50 a share. Let's call it 50. So what are the problems with True Social? Well, the problems with True Social are just infinite, really. This thing is going to die. Okay. So one of the problems that it has is that social media companies, they depend on their subscriber count. This right now has about 2 million active subscribers. Give you a point of reference, Twitter has about 450 million and Facebook has 2.9 billion. So this thing is a real baby. Now, worse is that 1 million of those downloads came in the first 2 weeks of its existence. And so it's been in existence for about 2 years that you can sign up for it. The first 2 weeks got you 1 million. The next 2 years got you the other 1 million. And now 2 million is nothing to sneeze at, but for a social media platform that's trading publicly, that's going for $50 a share, this is really bad. Okay, and so part of the reason why it won't grow or hasn't been able to grow has to do with its demographics and who it can appeal to. And you can see here its growth numbers. It started at 1 million and it's been dying ever since till finally this most recent number here is 35,000. And part of the reason for that is that 77% of the Democrat voters said they would never use this platform, but only 31% of voters said that they would use this platform, indicating that 69% of Republican voters said that they wouldn't use the platform either. And that of these Republican voters, only 14% said that they plan to use the platform a lot. I think we're starting to see the problem. Another problem that they have is that women don't want to use this platform. It says here that over 60% of women said that they would never use Truth Social. So this is a problem. Truth Social is now valued around $500 million. It has a $1.8 billion market cap. That's a problem. So there are a lot of problems with this platform. Another huge problem with this platform has to do with the fact that older people that generally identify as Republican will also not use this app or website at all. The people that tend to use these types of websites are 18 to 34 years of age. And they're not using this platform at all. So who's going to advertise on this platform? Who's going to finally make this thing profitable? I don't know. I Googled who advertises on Truth Social. Well, it looks like Mike Lindell of MyPillow does advertise on that, but by and large, it's miracle cures and scams. Because if you're going to be a person and you're going to run a scam, and if you, at least if it was me, the way I'm thinking, I want to go to 2 million of the most gullible people on this planet, and I will market to them. I will say that, let's say Taylor Swift is a government plant who's going to make the Kansas City Chiefs win the Super Bowl. These are the people I want to go after if I'm trying to run a scam. I think this thing is dead on arrival, and I might lose my $700 this first time, but I think in the long run, I will not lose my $700. So yeah, I guess it's really hard to build a business around owning the libs when there are no libs around to own. So what's the point? So those are my thoughts on the market here in the near term. I do believe that we still have a little bit of running room. And so I'm going to let things go for a bit before I really go heavy into like short duration fixed income. But I'm still, no matter what, going to maintain small positions in companies that I believe in the long run. And of course, I'll still own DWAC puts until it actually pays off for me. And I know it might seem that I'm bashing on Donald Trump brand or something like that. And there are a lot of people out there, they get super like, what is it? Like emotional when you bash on Donald Trump. Like they're like overly sensitive. I think they're called snowflakes, but they get really sensitive if you bash on him. But I'm just telling you that company is garbage and destined to fail. And then I'll continue betting against it until I see some sort of like positive change, or until that company finally goes to zero. And I'm willing to bet on. I'm not selling short on the company. I'm not short selling it. I'm just buying puts. And so my losses are capped at whatever it is I buy them for. All right. Well, thanks again for checking out this channel. If you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, have a great day. Bye.